Bullish sentiment among investors in the US continues to soar, reaching a new all-time high in November, while euphoria can get more euphoric, as Bob Farrell once said, quote, "When all experts agree, something else tends to happen." Now, I start this video off with that quote because I think it is detrimental if you do not watch this video. This is the video that you need to pay very close attention to, because right now it's hard to find someone that will even entertain the possibility of something not going right next year. We are all so consensus bullish that it's probably not going to happen the way that we think. Now, could next year be a good year? Yes, we'll talk about that in this video, but probably not the same kind of way that Wall Street is currently expecting. So we have a fun one for you. I mean, I love the weekend, not because we go out and party, because we sit here and we strategize. We sit here and we're not getting bombarded with headlines. We sit and we logically think and reason about markets and what's coming next. You know, I truly think the investors that think on the weekends are the most successful market strategists. The guys that don't log off the computer Friday at 4 p.m. and come back Monday at 9:30 a.m., but are actually thinking when there's nothing going on. Those are the guys that get it correct more often than not. So congratulations if you are watching this video. You are likely one of the few on Wall Street that actually thinks on the weekend. Okay, so here in this video, I will share with you what I expect will happen in December. Now, I'm just going to give that to you up front because there's only 3 weeks or so left in December, and take what you want with this information. But markets are most likely going higher. You can never be certain about anything, especially in regards to markets. There's only a certain degree of certainty you can put on anything. But odds are good that you do see a year-end chase, you see a Santa Claus rally, as we are really knocking out these risk factors, these risk catalysts. Like, we just got our jobs report on Friday, which was really bad, mind you. The household survey was terrible, like utterly a shit show. I mean, as Sven Hendrink said, since everyone's killing it in the market now, we soon don't need full-time employees any longer, with this metric down another 1% in November, with the gray areas being recessions. We are, like, from this data, in a recession. Not a super deep one, but in a recession nonetheless. Or from what Nick Timmerow said, the unemployment rate, which he thinks is the best summary statistic of the monthly jobs report, which unrounded was 4.246%, leaving it very close to the recent high of 4.253% recorded in July. This is when the markets had a bit of a freak out about a potential recession, right? The only difference is now you're getting a higher unemployment rate, but you're not seeing initial jobless claims that are spiking like you did then. And markets are fine with it. I mean, at least it felt like they were on Friday. Because I really think it's just seasonals at this point. It's the chase that is driving the markets at this point. I firmly believe this same jobs report in January or February or March of 2025 would have been seen totally different. I mean, this would have likely caused some fear about what the rest of the year is going to bring. But at this point, Wall Street says, hey, from now until the start of 2025, we're just knocking out risk catalysts. And no matter if they're good or bad, they're done. They're gone. You've seen this from the VIX on Friday, which was down almost 5%, which was already at a very low level to begin with, and it just went down further. People want to be bullish. The markets want to go higher, and that's probably most likely going to happen into year end, especially as, I mean, December tends to be a very strong month during election years. So by any means, I don't think you want to fight that. But I think the bigger thing that we must talk about is 2025. Because let's face it, there's only so much that is going to happen in the next 3 weeks of this year. I don't know what you guys want first. Perhaps we should start with what could go right for markets. See, and why I said at the beginning of this video, the people that are actually thinking on the weekends are the guys that most likely get the market strategy aspect of investing correctly. Whether or not you invest in the right stocks or whatnot, totally different. But actually theorizing about what markets are going to do is very important. And especially over the weekends, when you don't have all of these things going on, you can really sit back and reflect and just think about what's moving markets right now. And I will tell you, okay, this might sound crazy, but earnings do not move markets in the short term. Earnings are the only thing that moves markets higher or lower in the long term. If you want to take a 5 or 10 year perspective on markets, or even a 2-year or 1-year perspective on markets, it's all about earnings. If earnings are going higher, stocks are going to go higher. But what moves markets in the short term is expectations. That's why on any given freaking Monday, the markets can fall 3%, or a week can be down 5%. Has nothing to do with earnings or the fundamental picture of the markets changing. Just, if something dramatically changes, expectations changed themselves. Okay, now they can feed into each other, right? Expectations of a strong economy can feed into better earnings expectations, which can lead stocks higher. Expectations of a weaker economy can lead to expectations of lower earnings, which can lead the markets lower. What I'm trying to say here is expectations are massively important as we head into 2025. So what I have here is what could go right that is not necessarily priced into markets already. And then I have the market's assumptions currently, kind of the base case that everyone's talking about on Wall Street. Like, go to CNBC and watch any of the clips in the last 2 or 3 weeks, and they're all going to be saying basically these same things here. Number one, Trump's tariffs are mostly talk and no action. We're expecting some kind of tariff, like 10% perhaps, but nothing dramatic, nothing like the campaign trail. Okay, so that's number one. Wall Street is generally expecting 9 to 15% earnings growth next year, aka earnings acceleration. We're only looking at about 7 to 8% earnings growth for 2024. So this would actually be a pickup in earnings growth. Wall Street, generally from their price targets, are expecting a 10 to 15% gain on the SPY. So in translation, we're not really expecting any, multiple expansion. We're really expecting the earnings are going to drive markets next year. Okay, and that's a good thing. I mean, we're already very expensive as far as the multiple is concerned, over 22 times next year's expected earnings. Current assumption is that we will not have a growth scare or growth problems in general. We are currently expecting 2 to 3 cuts from the Fed next year, with a slew of deregulation, and I should also put here deregulation / M&A activity. Okay, that is kind of the assumption for next year. If all goes well, that's great. Now, what's going to move markets is the things that we're not expecting. So if we were expecting an average or not as great year next year, it would probably be a much better year if all of these things happened, right? Typically, if everyone's expecting something, it's not seen as good. Kind of like NVIDIA earnings. When everyone's expecting they're going to beat by $4 billion from their previous guidance, and they beat by $1.5 billion, like that's $1.5 billion beat. They beat on EPS like 25 to 50% basically every quarter as well. It's just not as good as far as a percentage return following Nvidia earnings. Nvidia actually was down after their earnings because everyone expected it. Okay. Now, what could go right? What would be a tailwind, tail risk, tail catalyst for next year? The markets are determined by tails. And you can think about this by, three different categories. In the middle, you have market expectations. Call it on the top. You have bullish tails, bullish catalyst, things that are not seen as a consensus that are really good. Like, imagine next year if there's no tariffs. Trump does no tariffs. That would be a tail, right? That would be something we were not expecting that is really good. On the bottom, you can have tail risks, and we'll get into those in just a moment. So what could go right? And this is, again, not expected currently on Wall Street. Inflation falls faster than expected. It seems like everyone is expecting stickier inflation. If inflation falls more than expected, that's a big positive for our markets in terms of how you value companies, right? Just from an easy maths perspective, if you expect 2% inflation for 10 years, that's 20% devaluation you have to assume on a company's earnings 10 years out, like a Palantir, right? Or a Tesla. If you're expecting 2% inflation for 10 years, in your models where you expect, let's say Palantir is going to do $500 billion, just making up a number here, of revenue 10 years from now, then you got to take 20% off the top or some calculation of that to account for inflation, right? So if inflation falls or goes up, that does actually affect fundamental valuation metrics. Okay. Now, second up is you have the economy that remains strong. Now, these kind of go hand in hand for the most part, historically speaking. So if inflation falls faster than expected, typically you do not see a very strong economy. Typically, when inflation falls, the economy is not doing 3% GDP, let's say. But we're talking about what could go right here. Let's say the economy remains at 3% or at trend growth where we are now with inflation that falls. That would be, the best news the markets could possibly get, all things considered. You have up here as well, AI that boosts company margins. AI is really not a revenue story at this point. It's an efficiency operation story. For all the small, medium, large size businesses that have been buying NVIDIA products, perhaps you could see a surprise to the upside on earnings growth next year with, most people are in that like 11 to 12% earnings growth range. If we could get like 15%, that would be on the high end of Wall Street's estimates, right? And that could happen via some of your AI, productivity boost. Deregulation on a larger scale, if we could really deregulate things and see more business investment because of that, see more housing being built, see more company formation, all the good things that go along with deregulation, I think that would be a positive surprise as well. You have $7 trillion in cash on the sidelines. Again, if these prior things happen, inflation falls faster than expected, economy remains strong, you will likely see that $7 trillion start to make its way into equities. And I have here as well, housing market boost. Okay, so if the housing market can start to move, if liquidity, if buyers and sellers actually start to buy and sell homes again, which they're really not doing right now, the housing market's pretty stagnant, if you will. If we could start to see that move, that would unlock a lot of equity in people's homes, right? People, if they sell their home, they get a large chunk of money in the bank. They're going to start buying cars. They're going to start doing this and that. If that is met with less inflation, that would be really good for markets. Now, what do I put the probabilities at some of these things? Well, I think inflation will fall faster than expected. I think that will happen. I don't know if the economy will remain strong at the same time. That's where, you really got to gauge these things out here. But these are some of the clear-cut things that could go right that are not necessarily priced into markets today. Because I don't exactly care about what's priced into markets, what everyone is expecting. I'm trying to figure out what people are not expecting and if those things can happen, positive or negative. Because if we meet expectations, it's going to be a pretty boring year. And we'll talk about what we would expect if that happened. But first, before that, we need to talk about what could go wrong. Now, I put this in a probability range, okay? So I have low probability here between a 5 to 10% probability for these three things. Number one, lower than expected earnings. I don't think this is very likely at all. I think earnings are not going to be a huge problem next year. I think earnings are going to come in good. There's no reason to expect that earnings would not come in good. Now, a bigger / larger breadth of tariffs and or a trade war. If Trump starts really trying to tariff China, for an example, China's going to tariff us back, and we're going to be in a 2018 trade war situation all over again. When that happened from October 3rd through December 24th of 2018, markets fell 20%. I mean, that's not a good scenario. I don't think that's a high scenario because I don't think Trump wants to be the guy that killed the markets, that caused a trade war, that caused inflation, that crushed the bull party after Biden did a good job. I think the last thing Trump's ego wants is to be showed up by Biden in terms of equity performance. So I'm not too worried about this. I think it's a low probability. But yeah, it's probably not going to happen. Another low probability, in my opinion, is another spike in inflation and or the Fed raising rates. I think this is a very low probability. I think you're going to see a lot of disinflation next year. And you could actually see inflation lower than expected next year, actually undershooting the Fed's target of 2%. Oh, and I should mention, how I think of these things, how I come to these conclusions or make a video like this is all I'm doing every single day is taking in information. And when I hear good information that is really not the consensus view that I also agree with, I don't want to say it's like a cognitive dissonance or it's nitpicking out different things that, a bias, right? I think it's a confirmation bias in a good way that maybe I'm onto something here. And I've been saying for a while now that I think inflation's going to, come down more than expected next year. I think next year could really be a year of disinflation. When I heard this, I got a lot more confident on that. Now, this is one of the top tech analysts in the world. This guy is like super bullish on all your tech names, okay? Just take a listen to this like 30-second part here of what he just said about the Fed and inflation, because wow.
A kind of hawkishness to the language that they can wait a little while. But my belief is generally that the data are going to start to confirm that the neutral rate is actually just where it was before COVID. So we're going to go back and realize that 2017, 18, 19 rate levels, the Trump 1.0 rate levels, are going to be consistent with the Trump 2.0 rate levels. And that's actually a way, way, way out of consensus view. I think most people, even at the Fed, but certainly on the street and investors I speak to, all seem to have come up with some rationale for raising their neutral rate forecast. And I think we're going to stand out. I'm going to stand out next year and into 2026, really pushing this idea that I don't think that's true. And we'll find out in the data. The data is going to come in and we'll see how the inflation data work. I think they'll probably surprise to the downside by the end of 25, maybe even the middle of 25. And that'll put some pressure on the Fed. But I really think that's an even more powerful positive for the risk asset story that Bob just outlined. It's an even bigger tailwind. So we agree on direction. I think I'm going to probably have a slightly bigger magnitude because just my rate view is so different.
I mean, I haven't heard anyone else in recent months say anything remotely like this individual here. Okay, That's what I've been saying on the channel for a while. Maybe it just feels good to have someone else say this as well, but it does lead me to believe that maybe we could be right with that. We'll see. Obviously, it's going to be a long year, but I do think by the end of 2025, this could be a big catalyst for markets. And again, that's why I put another spike in inflation and the Fed raising rates in the low probability range. What I'm more concerned about in the mid-range probability, between 20 and 50% here. This is what I think is logically something to be concerned with. There's three things so far. Now, as data changes, as the narrative changes, I will update this, okay? But as of right now, lower than expected GDP/economic growth, that's a problem because we're all so dead set that next year is going to be a good year for the economy. If it's not, that's a problem. Weaker labor market growth, weaker labor market / growth scare. I should have put a little slash there, make it easier. So that's kind of what we seen on Friday, was a weaker labor market report from the household survey, from the unemployment rate. That's a problem. Now, I had some people ask on the last video, what's a growth scare? And a growth scare is essentially just that, when expectations are really high and you start to get data that suggests maybe things are not as good as we think. That kind of brings out some of the bears, that brings out the pessimism, and people jump to conclusion that we're going to go into a recession like you've seen in July, August, September of 2024. That's what gave us our almost 10% correction there. But it doesn't always, the growth scares very rarely lead to recessions, but that is an issue. And I think we will get a growth scare in Q1 of 2025. Now, I also have here that Wall Street is generally too optimistic. And this is going to fluctuate a lot. But I do think as we head into 2025, if December plays out the way that I expect and we get a Santa Claus rally and the markets do go higher, we are definitely going to be entering 2025 in a very vulnerable position. And that's why I'm calling for a correction, which could be a pretty severe correction in Q1 of 2025. And in fact, it could start like the first week of January. It would not surprise me. Okay, so now to wrap all of this together, and I'm just going to give you my crystal ball kind of projection for next year. I think inflation will surprise to the downside. I think the Fed will cut rates more than expected because of that. Not necessarily a super weak economy, but because inflation is surprising to the downside. I don't think the economy is going to be running at, let's say, 3% GDP next year like it was this year. I think 1.5%, we'd be generous to be at that next year. That's wildly out of consensus. And I don't think that's a huge problem for stocks, as long as it's met with the Fed cutting rates, inflation falling, not that stagflationary environment. And 1.5% GDP is like, that's not terrible. You're not in a full-blown recession, but I do think earnings will come in good. So I think you mix Fed rate cuts with lower growth in the economy and good earnings. That is specifically the environment for small caps and mid caps to outperform, because what happens when you have, and this sounds wild to anyone that's invested in markets from 2020 through today, but if you invested in markets before COVID, then you're going to understand exactly what I'm saying here. What used to happen is when there was a lack of economic growth, when economic growth was not that impressive, investors sought companies that grew faster. Okay, so small caps and mid caps generally grow faster than large caps. It's the law of large numbers, right? And Apple's only going to grow so much versus a small cap or a mid cap, right? But it is going to be selective next year. I don't think everything is just going to go up for any old reason, right? I don't think it's one of those situations where all, rising tide lifts all boats. Good companies, growing earnings, in the small mid-cap space preferably are going to do well. I think selective big tech will also do well. Perhaps an Amazon. Perhaps maybe like a Meta. We'll see. I'm really uncertain about that one. I would have more confidence in like an Amazon, maybe a Google, because of where those valuations are relative to other big tech names doing better. I think it's really going to be a year of AI appliers, companies that are using AI to grow their margins. And I think a lot of that is generally going to be in small and mid cap companies. And I'm thinking of small caps like 2 billion to 10 billion, right? The standard definition of a small cap or a smaller cap company. So that's kind of my forecast. I do think markets are probably going to be up like 5 to 7% next year on the headline S&P, well below consensus. Consensus is expecting 10 to 15%. But I think it's going to be very volatile. And even if we do get a 10, 15% rise next year, I think there's going to be multiple corrections mixed in there with growth scares, with, a potential trade war. I hope Trump doesn't go down that path. But if that is the path, we're going to have a lot of volatility. And I think that's what we can expect, especially if Nvidia and Apple and some of your big tech names that have the huge weightings in the S&P and the NASDAQ really take a back burner. If markets get turned off by those stocks, I mean, you could see those stocks sell off, and that would create more volatility in the S&P. So I don't think it's going to be as broadly good as Wall Street does. I think next year is going to be a good year as long as we avoid a recession, which, again, it's still too early to tell, but it would make sense that we don't have a recession. I mean, I don't think there's anything strong enough to kind of push us there. Generally, recessions need catalyst. And if we do go into like a shallow recession, I mean, the Fed's going to, come on, the Fed's going to start printing like they're drunk again. I mean, there would be a lot to be excited about as well in that scenario after that initial recession fear kind of sunk in. So quality small, quality mid-cap companies, quality data centers, software names, second-tier AI stocks, appliers of AI, that is where you want to be. I also think cyclicals could be good, especially if we do have less government spending, less fiscal stimulus, and more actual growth in the economy. That could really help prop up some of your cyclicals as well, because not all GDP growth is equal. You can have 3% GDP growth that's really just government spending on certain sectors, or that's like 3%, or you can have a 1.5% GDP that is really being felt by the bottom up by everyone. And that's kind of what we had pre-pandemic, and people thought the economy was pretty good then, and cyclicals did pretty well in a lower GDP environment versus what we have today. So that's kind of my expectation, just a broad brush stroke here. Obviously there's different sectors I like more, but hopefully this does kind of put our markets into a little bit of perspective. There's going to be follow-up videos to this. There's definitely more to talk about as the story kind of evolves. But this right now is my best guess, best game plan for 2025. Thank you guys for watching. Hit the like button as well as subscribe to the channel if you have not done so already. Let me know if you made it to the end of this video as well, because this is a long one. And if you did, that is truly impressive, especially on a Saturday. Again, the best investors think on the weekends. And I have faith that's a lot of you guys. So nonetheless, that's going to do it for this video. You guys have a great rest of your day, and I will see you in the next one.